Okay, so let's look at question C, and it says refer to part B. Calculate Lindiwe's taxable income for the 2022 year of assessment. Lindiwe will elect any option to defer or minimize her taxable income. Now guys, remember that means that she will elect any legal option which is available to her and not something illegal, for example. Please remember that, never ever illegal. So these are the things which the Act allows her to elect to decrease her tax. So if you think about it, there are several sections in the Act, like for example paragraphs 65 and 66. Together with that goes section 84E. There's things like section 11O, the scrapping loss, and even things like section 13.3. All of those are things that she can elect legally to decrease her taxable income. And you need to assume that she will do it. She'll also, for example, if there's preferable exchange rates that you can use, like we've seen in this question, she'll also elect to use that. Okay, so when we do a calculation question, please remember our headings: description, calculation / explanation, CGT, although there's nothing in this question, I do recommend that you just include it, and rands. Okay, so remember guys, CGT, even if we didn't identify any in this question, so you could leave it out, but at least consider it. Okay, so let's go to the top of the question. So we start with our salary, 50,000 rands per month. Show your calculation nice and clear. Okay, then we've got overtime, 20,000 rands. These are all easy marks to score usually. There's always some of them in the question. Commission, there's also remuneration, and I just want to remind you guys, keep an eye out for everything that is remuneration here. Try and group it together as far as possible, because later when you do something like section 11F, you'll have to use it. So I do try and keep it together, and you shall see as we go, everything that's remuneration, I do try and keep together. This is not a requirement, but it's a good way of doing it. Okay, so let's look at now at the next one. So now we're going to look at our company car, our asset at decent value, and the interest-free loan. So let's start with this. Let's start with the company car. Okay, so the company car had a value of 580,000. We had it from March until, when did we buy it? End of June. Okay, 580,000. Right. Multiplied by 3.5% because there's no maintenance plan, and we had it for 4 months, March, April, May, and June. Gives us 81,200. Now we did do some business traveling, so we can deduct the business travel component from that. This is only if you've kept a logbook, and that'll be the 81,200 times the business kilometers over the total kilometers. Now remember guys, they give it for us for March and June, July and February, and the total. You need to know which one to use. In this case, you will use it for the period that we are looking at. We're looking at a company car from March until June, so it's March until June that we have to apply it for. Okay, so 2,500, 3,550. That gives us the business travel portion of that 81,200. So if we deduct that from the 81,200, sorry, I'm writing like an idiot, yeah? Okay, just the difference there. That gives us the private travel value, basically. And remember that now, because this is where students make a lot of mistakes when it comes to deducting the costs. You only will now need to deduct the private portion of the costs because you've deducted the business travel in total. So we've got maintenance, insurance, and fuel. Okay, remember the license is not covered by us or by Lindiwe. So March until June, July until Feb in total. We use March until June again. These are the costs. We multiply it by the private kilometers over the total kilometers. Private 1050 with 3550 for both of these. Again, remember we've already deducted the business portion in full above. So we have to do this only for the private. This is a common mistake that students make. Okay, then for fuel. Now, although we have a fuel cost there, remember that we have to use the travel allowance table. Okay, so you have to go and use the value of the vehicle, which is used in the company car calculation, which is that 580,000. So here at the top, where we calculate the company car, if you multiply it by 85% or you, so to reduce it for the determined value, if you don't have it, you would use the reduced value, whatever values that you use there. In our case, it's just 580,000. So we have to go and find it in our travel allowance table, 580,000. Sorry, it's here. And that's 150.9 cents. So we multiply that by our private kilometers. Remember guys, that's cents, so you have to divide it by 100 to get rands amount. 1584. Right, and we deduct all of this from the value of private travel, and this will give us our cash equivalent, which is the value of the fringe benefit. Now at the same time, I want you to also calculate the remuneration value here. This will just save you a little bit of time later. So 580,000 times 3.5% times the number of months, and remember times 80%. That is how we calculate the remuneration value. We'll use this for section 11F and so forth. Remember that 80%, we use 80% in all instances unless we can prove that more than 80% of our travel will be for business purposes. Now if we look here and just do the quick calculation, 2,500 business over 3,550 our kilometers there, that gives us 70%, less than 80, that's why we used 80% in our calculation. Again, you don't have to show remuneration right now at this point, but I like to do it here just so it's easier a little bit later on, as you'll see. Okay, so let's look at our next fringe benefit. It's the asset at less than the actual value. So we're buying it for 380,000. It has a market value of 460,000. Fringe benefit, asset acquired at less than actual value. As it wasn't purchased specifically for us, so we have to use the market value. 460,000, and we paid 380,000 for it as our consideration. Remember, it wasn't purchased for us. It was purchased to give it to us as a company car, but it wasn't purchased to be given to us, the asset. It was purchased to be used in the business, so that's why we use market value. So cash equivalent, 80,000 rands. And remember, this is also basically remuneration. There's no special rule here. Now, interest-free loan, 120,000. Remember, we wanted to pay 380,000. We had 260,000 in cash, so we got a loan of 120,000. Up until the 31st of December, it was 120,000. Then we paid 65,000 rands of the amount. So for Jan and Feb, it was lower, and the official rate of interest is 6%. Now remember, guys, with the official rate of interest, if the repo rate was given to us as being 5%, you'd have to add the 1% to get the official rate of interest. The official rate of interest is always the repo plus 1%. Okay, so let's go, and this is the fringe benefit, the interest-free loan. Okay, so from July, that's when we got it, until December, we had one value, and then for Jan and Feb, we had the lower value once we've paid at 65,000. So it's 120,000 times 6% minus 0%. That calculates the interest that we got for free, which is the whole 6%. And now we have to work out the amount of days. So July 31, August 31, September 30, October 31, November 30, December 31. That gives us the days. Remember, always use the days. That's 184 days out of 365. And then January and February, 120,000 minus the 65,000 we paid. Again, calculate the interest. And Jan has 31 days, February has 28 days. So 59 over 365. And 630 and 533. There we go. Nice and easy. Okay, so now we want to calculate this wear and tear. But remember, because of the condition of work that she has to travel. But before we do this wear and tear, I want you to see now the rest of the question. We just quickly take a look at it. What else is there? There's some costs we have to talk about here with the vehicle. And all sorts of things. So before we do that, guys, what I would recommend that we do, if we just take look a little bit further, there's the Provident Fund, the rental property, the foreign interest. So we're moving away from the remuneration amounts now. So what I would recommend that we do is you give yourself a little bit of space here and then calculate a subtotal. And that subtotal is something that we'll use a little bit later on to help us calculate remuneration. I'm just going to call this subtotal A. Okay, so let's just quickly add up everything here. And I want you to please remember to add up everything only once. Right, so only add it up once. So if, for example, you miscalculated something here and you typed 1274000, that's fine. Only add it up once. You're not going to get a mark for the subtotal. Don't waste time adding up totals. That's not going to give you marks. That subtotal you're going to be using. We're going to use this subtotal A later on as part of our calculation for remuneration. Okay, this is just my exam technique. You can do and calculate it like you want. Just remember that company car amount in there is the only amount which is not proper remuneration, because that's the fringe benefit value, and we calculate it a little bit differently, the remuneration. So let's do our wear and tear now. Okay, so remember the wear and tear, that's our next part like we were saying, and we have to calculate this wear and tear on the value of the vehicle at the time that we get it, 460,000. We divide it by 5 years minus the 2 years that it's already been used. We multiply it out by the months we use it, which is from July until February, the end of the tax year. That's 8 months. And then we have to get it for the business kilometers. Remember, only for the business portion. So July until February. Over 18,300. There we go. Those are business kilometers. You can't do it for the total. You have to apportion it out. Okay, so this gives us the wear and tear. Remember, it's a deduction. Okay, so now what about these other costs that we've incurred from July until February? Maintenance, insurance, and fuel. Can we claim that? Okay, remember, it's denied in terms of section 23M. Why? Because we earn mainly a salary. So let's just put it down here, address it. There might be a mark for it. Vehicle costs, it's not allowed, as she earns mainly salary. This is section 23M that tells us that. Remember, if you earn mainly commission, it was a different story. Then she could claim it if it's in the production of income. You'd still apportion it for the business kilometers part still. Right. Then we have our Provident Fund. Now the Provident Fund, section 11F, we have to do right before section 18A, which is our donation section, which is last. If there's no section 18A, section 11F is last. So we have to do that a little bit later. So let's move on to the rental property. Okay, so she got it in 2019, so she had the 3,000 rands per month for 5 units the entire year. So for 12 months. So let's start with our rental property. We've got the rental income, 3,000 rands a month for 5 units, 12 months, 180,000. Yes. Okay, so I'm just putting it in here at this point in time, and you'll see. You could have also put it into your gross income amount already there. I'm just going to use this for a quick explanation in a short while, so you'll see me coming back to this. Okay, so now we can deduct all of our costs from this. Now remember, the one thing that we have to consider is whether or not this is a low cost residential unit. So we do a little test for that. You have to show the examiners your thinking. So this is defined in section 1. How do we know what it is? It's if the cost must not exceed 350,000 rands. So what is the cost in our case now? They told us that it's 1,950 for 6 units. So what is the cost per unit? $325,000. So that's less than our 350,000. Okay. Then the monthly rental must not exceed 1% of the cost. So what's 1% of our cost? So remember, per unit, guys. 3,250. And what is our monthly rental? Our monthly rental is 3,000. So does it exceed the 1% of the cost? No. The cost is also, first bit is done, second bit of the definition is done. So in this case, the units are low cost residential units. Cost does not exceed 350 and it does not exceed 1% of cost the monthly rental. So they are low cost residential units in terms of section 13.6. Also see the definition in section 1. Okay, so now we can deduct our costs from the rental income. So they've given us some costs here. Remember, guys, you'd have to consider each of those items there. We've already done that. There's nothing in there like capital or so forth. So we can deduct all of these given costs under section 11A, general deduction formula. 103,200. Now I can do section 13.6. So it's the cost per unit, 325. There's 5 units which are being used as residential accommodation, so being rented out. We multiply that by 55% because we've got 6 apartments in a 30 apartment building, so we've got a part of a building, remember that? And we multiply it by 10% because it's low cost residential units. Usually it's 5% if it's not low cost residential units, but we use 10%. It's 89375. So if we add all of this up, it gives us an assessed loss from this trade. Now remember guys, can you claim this assessed loss? Right, you can, but please remember you have to consider section 20 capital A here. If this was a suspect trade, it would be ring fenced, that whole thing. If it was a loss in the last 3 out of 5 years, it would be ring fenced. Also just remember all of the requirements to ring fence that amount is that this must also be a person who is paying tax at the maximum marginal rate. Okay, for section 20A to apply. Okay, foreign interest, next up. We're getting there. Okay, so this is a nice, interesting one. I expected a number of you guys to mess some things up here. Let's start with the interest received. So how much interest did we receive? We received $2,000. So we have to translate that into rands. Now we're going to use spot or we're going to use average. It was earned evenly over the year, so we have to use the average exchange rate. You can't use spot because what's the date? It was earned evenly over the year. Okay, so this isn't due to an option for the taxpayer. This is the only one that makes sense. So that means 29,360 income. Now we have to do our forex gain or loss, and this is on that foreign currency. Okay, section 24I. So we've got a spot rate, we've got an average rate. Which one should you use? Well, that depends on what it gives us. So let's do both of them. So it's a 35,000 foreign currency that we've got in the bank. We multiply that now out for the spot rate and the average rate. So for the spot rate, remember guys, we're doing this on translation date. Sorry, that's the end of the tax year. So let's look at the spot rate. So the spot rate is 1345 at the end of last year, and it is 1502 at the end of this year. So 1502 is 1345. That gives us a gain, and you see the amount has increased. We've got more South African rands now, 54,950 as a gain. And now let's do the same for the average. The average last year was 1326, and it is now 1468. 1468, that's 1326, still a gain. And how much is this gain? 49,700 gain. So which one will she use? Spot gives us 54,950, and average gives us 49,700. Both of these amounts included in gross income. So which one will she use? She will choose the lower one because it's less tax. So she'll choose to use the average. Okay. So now the only thing we have to do is the provident fund. So before we do the provident fund, we have to calculate a subtotal. Now again, give yourself some space so that you have place to go and insert amounts if you forgot anything at some point, just a bit of exam technique, and then we calculate our subtotal. So this is subtotal B. We add up everything we've got so far. Okay, 1, 2, 6, 4, 7, 1, 3. Now, you would then have to do your taxable capital gain. There's nothing in this question, but I'm just showing it to you to remind you where it goes. Okay, so we've got subtotal B. This is the amount before CGT. Then you have CGT, you add it up, and that gives you subtotal C. I'm going to refer to both of these amounts when I'm doing section 11F now. So section 11F starts with the actual contributions to the Provident Fund, which is what? It's 5,000 rands a month. So for 12 months, 60,000 rands. And now we have to start off our limits. This is limited to the lesser of 350,000 or 27.5% times the greater of remuneration. See, there's that figure we keep talking about. We'll see the calculation of that. Or the taxable income including CGT. Which is subtotal C that we calculated above. What's that? 1, 2, 6, 4, 7, 1, 3. Okay, and then our last limit is the taxable income excluding CGT. So that is subtotal B over there. Okay, I know they're the same amounts in this case, something like A, B, and C, but remember the principle around it. Okay, so we have to calculate that remuneration. So let's do our remuneration calculation. Now we've done a lot of the work already to calculate remuneration. And again, guys, here you can do it in any way that you want. But if you use subtotals like we have earlier, then it becomes a little bit easier. So let's go and look at our subtotal. So subtotal A, where is it? Right, subtotal A includes all of these amounts, that 1,273,638. That is our subtotal A. Salary, overtime, commission, all of these things. The company car, it includes the fringe benefits. All of those amounts are included in that 1,273,638. So that's our starting point. We're going to now fix it up to get all of the amounts in or out which shouldn't be there. So let's start with deducting the amounts which are not remuneration, which is included in there. And what amount is not remuneration? It's the company car fringe benefit. Okay, because remember that gets calculated in a different way in terms of the 7 schedule. So it's that, where is it? That 19,475. That is not remuneration. That's a fringe benefit value. Right, the other fringe benefits are the same, but the company car gets calculated differently for remuneration. So we now add the remuneration on the company car. So using the remuneration rules. Okay, and what are those rules? You remember, it's the one we calculated already. 580,000 times 3.5 times 4 months times 80%. That's 64960. Now we can just add that in here. So there we go. That calculates our remuneration for us. Nice and simple. If you didn't do those subtotal A there, you'd have to add everything up. Show your examiners clearly, guys. However you want to do this, this is just my preferred way to do it. Okay, but you must make it clear for them how you calculate it. Right, so now we have to use the greater of remuneration or taxable income. So it's the 1319 or the 1264. The 1319 is the greater. So 27.5% times 1319123, our remuneration. That gives us 362759. Okay, so now we have to use the lesser of 350, 362, or 1264713. The lesser is 350,000. Right? We have to write it, and we have to then make our decision about how much of our actual contributions can we deduct. And that will be the full 60,000. Okay, that's it. That gives us our taxable income. So 1264713 minus 60,000 gives us our taxable income. Okay guys, so the next part of the question is not part of the required, but I'd like to just talk about how we are going to be calculating the rest of our tax. Just to give you a complete picture here. It's not part of the required though. So next up we're going to calculate our tax per our tax tables. Okay, so that's on that 1204713. So we go to our tax table. Okay, when I can eventually find it, here we go. So it's that 208,732 plus 41% of the amount which exceeds 710,000. So tax 208,732 plus 41% of the amount 1204713, our taxable income, minus 710. Okay, 411564. From this we deduct our primary rebate, okay, whichever is applicable. In this case again we're just using the amount given to us here, 14112, which I've given to you guys. Okay, calculate that subtotal over there. That's basically our tax for the year before other rebates. Now you would deduct all of your other rebates, section 6A, section 6B if there were, and also section 6 quat, which I'd like to just quickly talk about. Now you might not have studied it yet at this point in time, but section 6 quat applies when there's an amount in your taxable income which is taxed in South Africa, right, in that taxable income, taxed in South Africa and also in a foreign country. So this foreign interest that we had here was taxed in South Africa as well as in a foreign country, because if you go and look, it tells you here that 15% of the amount was taxed in the States. Okay, so the section 6 quat, you have to calculate how much tax was paid in South Africa on that amount and how much tax was paid in a foreign country. In South Africa, how much tax was paid on it? It's the amount which is included in our taxable income, 29,360. You divide it by your actual taxable income, that 1204713. So now you have a percentage of that amount. We multiply it by our tax, 411564. So that tells you how much tax did we pay in South Africa on the foreign interest. So that 29,360 rands resulted in 10,030 rands in tax. 29 results in 10,000. Okay, so how much tax then did we pay on this in America? So tax paid in the foreign country. Okay, it was $2,000, 15% of that. Now we have to translate that to rands. Now section 6 quat tells us that you have to translate that using the average exchange rate. You don't have a choice. It must be the average exchange rate. So the average exchange rate for this year was 1468. Okay, so that means the amount to be paid tax in America was 4,404. So the lower of those two amounts is the section 6 quat amount. So in this case, the 4,404 rand, which is the lower amount. So that just stops you from paying tax on the amount twice. So it was already taxed at 4,404 in America using the average exchange rate, and it's included in that 10,030. So you can't pay tax in the same amount twice, so that's why we get that as deductions. Always the lower of the two amounts. Okay, I just wanted to show you this for section 6 quat at this point in time. Right, now guys, once you've got this amount, from this obviously you would deduct any of your other prepaid taxes that were paid, like pay as you earn, and the first provisional tax, like we saw on the first part A and part B of this mark brace, they would get deducted here, and that would then calculate your final tax liability. Now this question asks you to calculate taxable income, guys. That's where we had to stop. Everything I did here is just for illustration purposes. Don't do that if they don't ask you in the exam. You won't get marks for it. Follow the instructions carefully. It is important. Otherwise you'll lose time. And that's it for this question.